All right, part 2 for week 9 videos, and our last part at least. So I can't believe that last video was 42 minutes, and I literally talked as fast as I could. I just talked about too many things. All right, so Colbert Nation incorporated in the state of Delaware. That's a very common state of incorporation. However, it's headquartered in Hollywood, California, has offices in Hollywood, New York City, and Chicago. And Colbert Nation serves clients in California, Washington, Oregon, Nevada, Illinois, and blah, 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 blah. So a bunch of different states. It also has employees from different offices serving different clients. So, for example, California employees work on California, Washington, and Ohio clients. But New York employees work on those clients, and also Illinois employees work on those clients. So we've got this diverse set of business locations and employees, and the question is, how are we going to determine how to split up state income taxes, right? So Colbert Nation is a single corporation, so how are we going to measure the income that belongs to any particular state for it to tax? So let's say Colbert Nation generates $500,000 in taxable income. What states get to tax it? How much of that $500,000 do they get to tax? And how do we go about calculating the right amount of taxable income in each state? So all of this starts with this concept of nexus, right? So nexus is our starting point, and this is the connection that is required, the minimum connection required for a state. Really, it's a jurisdiction, but in this case, states, a state to tax a foreign business. So that's a business not from overseas, but just outside of the state. So if you got to dream up the rules and you lived in the state, then you would say, all right, the starting point is I'm going to tax all income from whatever source. A little bit like the federal government does, right? So Eugene and Agnes Lipskowitsky, they live in Utah. And each August, they come to Davis to go to the soybean fields. And I don't even know that there are soybean fields in Davis, but I know there are fields everywhere around Davis, and so I pick soybeans. But at least once they go into downtown Davis and they enjoy a little bit of epic wings and things because they love the wings. They love that mild sauce on the tenderloins. So Utah says that because Wings and Things is selling to Utah residents, they are taxable. Okay, so remember, this is under the I'm going to tax all income from whatever source. Well, how's Wings and Things going to feel about Utah taxing their income? They don't have any stores in Utah. They don't have any employees in Utah, and no real connection to Utah. Now, I don't know that that's true. Wings and Things may actually have those things, but for our hypothetical, we're assuming that's the case, that they don't have any connection whatsoever to Utah. Well, that feels entirely unfair for the state of Utah to tax the Wings and Things located in Davis, California, because there were a couple Utah residents that ate there. So again, nexus is the minimum degree of contact between a business and a state that's necessary to establish jurisdiction. And each state gets to define nexus. But I'm pretty sure I don't like this prior definition with the Lipskowitzkis. So let's look at how California, because that's the state we are all in at the moment, let's see how they define nexus. So entities subject to the corporation minimum franchise tax include all corporations that meet any of the following. So if they're incorporated or organized in California, well, that means they're not a foreign corp, right? So being incorporated in a state definitely is adequate to trigger taxation in that state. Being qualified or registered to do business in California is enough to trigger nexus. Or doing business in California, whether or not you're incorporated, organized, qualified, or registered under California law. So really that means that doing business is enough to force you to have to pay corporate tax in the state of California. So what does doing business mean? Well, according to California, it means actively engaging in any transaction for the purpose of financial gain or profit. Well, that's a pretty broad scope. So let's see what the California Secretary of State says. Sorry, what the Franchise Tax Board says. It says, in the case of a corporation qualified with the California Secretary of State, but not doing business in the state, careful attention should be given to the term doing business. It is not necessary that the corporation conducts business or engages in transactions within the state on a regular basis. Even an isolated transaction during the year may be enough to cause the corporation to be doing business. So my favorite example of this is, okay, let's say I lived in New York and I'm flying to, I don't know, Shanghai to do work, and my flight stops over in LA because there's no nonstop from New York to Shanghai. And so as I'm sitting in the LA airport, I get out my laptop and I open it up and I do a little bit of work. I answer some emails, I do things like that. Is that an isolated transaction? Yeah. Is that enough to cause the corporation I work for to be doing business in California? Well, there's actually some chance under these rules that it could be. So, really, when we have this aggressive type of definition, we need to have some defense against this, right? So what's our defense against the dark arts? Well, we have a few. But the first ones come right out of our U.S. Constitution. And the two clauses that we see most often referred to are the Due Process Clause and the Commerce Clause. So the Due Process Clause says there needs to be some definite link, some minimum connection between a state and the person, property, or transaction it seeks to tax, and that the income attributed to the state for tax purposes must be rationally related to values connected with the taxing state. So this is where, does me flipping open my laptop in the airport, does that give me that minimum connection that's required? And I don't know, right? It's hard to know that, right? There's not a bright line test. Let's see what the Commerce Clause of the U.S. Constitution does for us. So the Commerce Clause gives the federal government the right to regulate interstate commerce. And in a famous court case called Complete Auto, the Supreme Court applied a 4-part test. It said, look, we're going to sustain a tax against the Commerce Clause so long as it meets the following 4 requirements. 1, it's applied to an activity with a substantial nexus with the taxing state. Okay, well, that should make us feel a little better because it's not just any nexus. It must be substantial nexus. 2, it's fairly apportioned. 3, it does not discriminate against interstate commerce. And 4, is fairly related to services provided by the state. Okay, so with those 2 backstops in place, we at least have some protection, right? So again, how do we define significant nexus? Well, it's still left to the states. So what we know for sure is that any one of the following corporate activities will establish nexus. Owning or leasing property or employing capital or property in the state. So if you have property in the state, you're done. Having employees in the state, you're done. Or deriving income from sources in the state. Okay, so any of those 3, and we think of those as being property, payroll, and income that's coming from the state. Any of those is adequate to establish nexus. There is one further restriction, and it comes from federal law, and it's a fairly old federal law, Public Law 86-272, and it says an activity is immune from net income taxation if it consists merely of solicitation of sales of tangible personal property. So let's make sure we understand those requirements because they are narrow. It can consist merely of, so only solicitation, so no other activity but solicitation, of sales of tangible personal property. So services don't qualify for protection under PL 86-272. So it's only solicitation of sales. So solicitation is basically advertising, and it's got to be for tangible personal property. So in addition, in Quill, which was a use tax nexus case, courts held that some physical presence is necessary. But for now 2 decades under the Jeffrey case, that has been continuously eroded, and it's much more likely that we need to be looking at an economic presence test, not a physical presence test. So there's also something called factor nexus. So factor nexus can be defined, for example, by, if you've got 50,000 of payroll, 50,000 of property, or 500,000 of sales, we don't care whether you're protected from Public Law 86-272 or anything else, you're going to be subject to tax in our state. So obviously owning property or employing capital is going to be a problem. We know employees triggers nexus. What about independent contractors? Well, there's a couple court cases that say those aren't necessarily going to insulate you from nexus, right? For example, the Scripto and the Tyler Pipe cases where there are independent sales reps soliciting orders, those triggered nexus. Deriving income from sources within the state. So deriving income means sales, right? So from within the state of tangible goods, well, that's typically the destination state. So where do you source income? Well, typically the destination state, because that's where title transfers, right? So I buy something, it goes on the truck, it comes off the truck at my warehouse. That's when the title transfers and I own it. For services, it's generally where those services are performed. So in our example here, let's say we have sales. Company A sells tangible goods to customers in all 50 states. Do they have nexus in all 50 states based on sales alone, right? So only based on sales. If Company A ships the goods in their own trucks into each state, and the answer is almost certainly they do have nexus if they use their own trucks. Number one, they have trucks rolling through each of those states. And number two is that's where the income is being sourced from, because that's where transfer is being titled. So for years and years and years, the way around this was to ship your goods using what's called a common carrier, like the U.S. Postal Service. So what happens is title transfers not at the destination, but at shipping point, right? So now it becomes the liability of the common carrier and then ultimately the liability of the customer. And so as a result, that sale would be sourced from its origin state, not its destination state. So Company Z is headquartered in State A, and it has nexus in State A and State B, and the following forms of taxable income and deductions. All right, so when we look in total, it's got revenue of $9,000, cost of goods sold of $2,000, some selling general and admin costs of $1,500, depreciation $900, interest income of $500, and interest from a rental property located in State A of $200, and then some interest expense of $700. And we're back to kind of this question. Okay, so now that I've established that I have nexus in State A and B, I have that minimum connection, how am I going to split this income up? Who gets what share? Well, step one is we need to recalculate, if you will, income in accordance with that state's rules. So what is the proper amount of depreciation, right? So what if the state doesn't follow the federal depreciation rules? What if they don't allow bonus depreciation, or they don't allow Section 179 depreciation? And what about special rules like charitable contributions or NOLs? So does the state permit charitable contributions being limited to 10%? Do they have to be to in-state charities? Can they be in-state and out-of-state charities? And what about NOLs, right? Is it the full federal NOL? Is it some part? So state laws tend to be pretty similar to federal law, but they're not entirely the same. So taxable income calculations are close. So typically what customers do, clients do, is you start with federal taxable income, and then you adjust that for any state differences. So for example, federal depreciation might be $900, but calculated under State A rules, it's only $600. Well, as a result, federal taxable income would be adjusted upward by $300, right? We only have a $600 deduction, not a $900 deduction. So I take federal income and jack it up by $300. Common, what are called federal to state adjustments, or Fed state mods, right, modifications, are listed on this slide, right? So lots of things that you might or might not expect, but this is just a list. And just because they're on this list doesn't mean every state follows them, right? So for example, federal bonus depreciation is a very common, like a lot of states did not adopt bonus depreciation, but some did. And so oftentimes the answer for state tax questions is it depends. And it can depend on what state the transaction is located in. All right, so what this means is we have to do a separate calculation for each state. And that separate calculation, remember, we are not even yet carving up the income. All we're doing is recalculating it under state's rules. And since State A and State B may or may not have the same rules, we need to recalculate it. So sure enough, depreciation is $600 for State A and it's $500 for State B. Now that doesn't mean that it's $600 for A, $500 for B, so it's $1,100 in total. No, that simply means State A only allows $600 of depreciation this year. State B only allows $500. Federal interest income from U.S. Treasury bills. So interest income is from U.S. Treasury bills. So hopefully we remember the rules from, well, actually you probably don't. So that U.S. Treasury bills, U.S. interest income is, of course, taxable federally. but it is often exempt from states. So you can see that on the interest income line, state A and state B both reflect 0 for interest income. Also, not included in federal income is $200 of muni bond interest from state A. So remember, states may not respect their own muni bond interest rules. Now, they may or may not, but we know we need to adjust federal income by that amount. So we're going to drop the $200 into both. That recalculation, or not into both, but into state B, because state A exempts them. And that's the typical rule. So what we've done is recalculated total income, right? I think of that as worldwide income, but based on the rules of state A and state B. And you can see that, our federal number was 4,600, our state A is 4,400, and our state B is 4,700. Okay. So does the state base represent taxable income? And absolutely not, right? So now we need to take each state's base and divvy it up. And there are 2 agreed upon methods for doing this. The one is what we call allocation, which is a direct allocation of an item of income or expense to a specific state. And the other is apportionment. And apportionment is an artificial method by which, using factors, we're just going to estimate how much belongs to a particular state. Okay, so typically non-business income is allocated, but business income is apportioned. And the states, each individual state gets to define what is non-business and what is business. So generally what happens is they define non-business, and by default, everything else is business. So what kinds of things are often defined as non-business? Well, rents and royalties, capital gains, interest, dividends, and royalties again. Wow, I'm so happy I mentioned it twice. Okay, so what are the typical rules for these, right? So tangible property, rents, and royalties, that's typically the state where the property is or is used. And that's basically the same for California, right? If the property's in California, then it's California. If it's in a non-taxable state and the corporation is domiciled in California, then it's California also. Capital gains, state of commercial domicile, interest dividends, state of commercial domicile. Well, what is commercial domicile? Well, that is not where you are incorporated. Instead, that represents where the center of your operations is. So we typically think about that as your corporate headquarters. For intangible rents and royalties, it's where that property is used. Okay, so when we sit down and look at our previous example here, what is the possible allocable income? Well, the interest income is allocable. The rental income could be allocable. And the interest expense, well, no. Generally, business interest expense is not allocable. That would be apportioned. So notice that interest income and interest expense are not mirror images, right? They're not symmetric. Okay, so that would mean that we need to decide what is allocable and get that out of there, right? So let's look at what we did for state A. We said, okay, well, what is allocable? Well, we know the muni bond interest and U.S. government interest is allocable, but notice we didn't include any U.S. government interest. So we don't have to worry about that. And the muni interest income, well, that was only part of state B's rules, so it's not even in state A. So the only income we included that's allocable in state A was the rental income. So we're going to get rid of it. We're going to take it out, because what that's going to leave, the residual, is everything that's apportionable. We do the same thing in state B. So the U.S. government interest, not in the federal number, or not in our number to begin with. So it's out of the state base already, so no adjustment. The muni interest income is in there, but it's allocable. And the rental income is in there, but it's allocable. So again, we back both of those out, and we get the residual, which is the apportionable income. Okay, so how do we apportion income? Well, each state develops its own apportionment system. I've linked in the slides. You can go there and see what each state does. So let's start with the history of apportionment, even though no one hardly uses this anymore. And it used to be a 3-factor apportionment formula. You would measure the sales, property, and payroll in state divided by everywhere, right? So what is the sales into California divided by the total sales? What is the property in California divided by total property? What is the payroll in California divided by total payroll? Well, think about it. Those lined up with our old-fashioned nexus driving factors, right? It was income, property, and payroll. So think of those as those were selected because they represent economic activity. All right, so 35 states now use a single sales factor. 8 states use a double-weighted or triple-weighted sales factor, and California is now a single sales factor state. So that means the only factor that's used is sales. So you take California sales divided by total sales, multiply that by the apportionable income. That's the amount California gets to claim. So again, what do? Sales in divided by sales everywhere. Property in divided by property everywhere. Payroll in divided by payroll everywhere. You add those 3 together and divide by 3. That gives you your apportionment factor. If it's double-weighted sales, then you double sales and divide by 4. And single-weighted sales is just factor 1. So typically to calculate the sales factor, you're actually considering gross receipts from in-state sales divided by total gross receipts from all sales. So the sales factor considers gross receipts from transactions and activities in the regular course of a taxpayer's trade or business. It normally includes, but is not limited to, gross sales, fees and commissions received for services, rents and lease payments received from renting real or tangible property, proceeds from the disposition of other tangible and intangible assets, although sometimes that's only the gain or loss amount, and royalties and other payments received from the sale. So it's supposed to be a fairly all-encompassing number. Payroll is compensation paid in the regular course of business. So that's wages, salaries, commissions, and any other form of remuneration paid to employees for personal services. It does not include amounts paid to independent contractors. Some states will exclude officers' compensation from the payroll factor. And it can get tricky when employees work in multiple states like consultants, or even, not so much in California because we're such a large geographic state, but think about working in New England, where the states are much smaller and it's more likely that you are traveling across state lines to serve a client. Well, if I work in New Hampshire, then I'm going to be taxed in New Hampshire. And my employer has triggered Nexus in New Hampshire, and now it's going to want to record that payroll in New Hampshire. So it can get complicated. The property factor is the cost, typically the cost. That's not the net book value. So think of that as that unadjusted basis like we had in QBI of real and tangible property located in state, of course, divided by real and tangible property everywhere. So in general, you would use anything that's used in business. Intangible is not usually included in the property factor. It's usually only property used to produce business income, not non-business income. And it's typically valued at its average. So you take the cost of whatever at the beginning of the year, the cost at the end of the year, and you average them. Rented property is usually valued at 8 times the annual rental cost. And again, it's typically gross value, right? We do not depreciate this now. So MIC generated $100,000 of apportionable income, has the following apportionment of sales, payroll, and property. So we've broken down the 3 factors. Here's how much sales into every state, payroll into every state, and property in every state. So how much of that $100,000 of apportionable income under New York rules is going to go to New York? Well, we got to figure out first off what is New York's system. We're just going to assume that New York is an equally rated 3-factor apportionment formula. It probably isn't, but we need to do one just to practice. So we take sales in New York, 300,000 divided by sales total, 750. Payroll in New York, 400 divided by payroll total, 550. And payroll, 100,000 divided by payroll or property total, 180,000. So we calculate those ratios, 0.4, 0.727, 0.555, add them up, divide by 3. It's 56%. And so New York is going to claim $56,070 of that $100,000 of taxable income under apportionment. Now, there could be allocated income that needs to be added in, but right now we're just dealing with apportionment. So note that MIC had a large proportion of payroll and property in New York State. So it must be that, maybe the bulk of this company's operations are in New York. Maybe it's headquartered out in New York and started in New York. And so New York says, hey, we kind of want to favor companies that have a big presence in our state because we want them to grow here, right? We want them to be successful and their employees vote for us. And so maybe what we'll do is we're going to change and say, oh, instead, we're going to double the sales factor. Okay, so we take the sales factor now. Recall that it was 300 over 750. We double it, right? So times 2, it's 0.8. Notice that our total apportionment factor is now down to 0.521 versus 0.5607, right? So now what's happening is the amount of income being apportioned in state to a company that has large operations there is lower, right? So this benefits companies with large in-state operations. So what if we said, oh, well, then it's triple weighted sales or quadruple weighted sales? Well, what's going to happen is more and more the sales factor, which you can see is distributed more evenly across the states, is going to drive the amount of tax in New York State as well, because we're ignoring, or it's becoming less relevant, how much payroll and property you have. So to give them the complete benefit, you would say, well, I'm infinitely going to weight the sales factor. And that means it's just a single sales factor. So at the single sales factor, it's just 0.4, right? That's the 300 over the 750. And so that's the amount that would be taxed in the state of New York. And so you can see that gives a benefit to a company with a large in-state operation. So some states don't have a corporate income tax. And in the good old days, that went untaxed. But many states have instituted what they call the throwback rule. And the throwback rule only applies to the sales factor. And it's where sales, and only sales, not the other items, are thrown back to the state in which the sale originated. So it does not affect payroll and property. So again, MIC, all 50,000 of the sales, right, are into Texas. Well, Texas has no corporate income tax. But because the actual business is based in New York, that's where the sale originates from. So it goes on a truck in New York and finds its way to Texas. So we're going to say that the sale originates in New York. And so we're going to throw that back, that sale from Texas back to New York. So now the sales factor in New York isn't just 300, it's the 300 plus the 50 from Texas. So 350 over 750 is now 0.466. If we double weight that, it's 0.932, et cetera, et cetera, et cetera. So the throwback rule is a way of tapping into some of that income that is being untaxed otherwise because it's into a non-tax state. Okay, so let's go back to our company. Remember, we ended with our state apportionable income of 42 and 4,300. If we get our apportionment data,